The Accunet Mortgage and Realty Show is sponsored by Accunet Mortgage, an equal housing lender, NMLS ID 255368, and Accunet Realty Advisors, which is a separate company from but still affiliated with Accunet Mortgage.
Putting a roof over your head without the headache. Get answers to all of your home buying questions. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And our Sunday best to you. Good morning and welcome to the Accunet Mortgage and Realty Show. I'm Steve Kettlear, along with Accunet Mortgage and Accunet Realty Advisors owner Brian Wickert. David Wickert has today off. So if you've got a question or a comment, you can call us or text us on the Accunet Mortgage talk and text line at 414-799-1620. Before we get into all of the numbers and all of that stuff, let's talk a little bit about what you guys have been doing at Accunet with regard to Habitat for Humanity, because I know that's an ongoing project for you guys.
Right, and well, this past week we just had a beautiful weather week, Monday through Friday.
You know what? We're going to have to reconnect with Brian Wickert and see if we can get that going, because throughout the year, Accunet also works with Habitat for Humanity, and they've got a home that they're sponsoring this year. And we can learn a little bit more about, what it takes if you're a business owner, small business, and you'd like to become a Habitat for Humanity sponsor, or maybe on the other end of the spectrum, you would like to become a Habitat for Humanity homeowner. How does that work, and how does that come about? And when it comes to sponsorship, how do these homes get built? Exactly what goes on there. So we'll talk a little bit about that. And later on in the program, we're definitely going to be focusing in on the Fed, which this week they could have another tick up in the interest rates. So that could mean changes for the mortgage lending rate, or maybe not. It's been interesting to see how things have reacted in that department. We'll also take a look at the May home sale numbers for the greater Milwaukee metro area, which has had a pretty doggone tight inventory situation. And that has kind of eaten into sales for the last year, because if you don't have as many homes to sell, then you don't have as many sales. So, Brian, let's jump back into what's been going on with Habitat for Humanity, because I know this has been an ongoing project for you guys.
Yep, this past week was the Blitz week, meaning that not only was Accunet's house being worked on, but 4 other houses in the Washington Park area. So we had people out there from Accunet. We had mortgage people, pencil pushers, Excel geeks were out there swinging hammers and putting up walls and having a good time, working side by side with a lot of the homeowners out there. And we made a lot of progress, Steve. We went from a foundation that had only the cap on it, and we put up a 2-story house by the end of the week.
Yeah, it's amazing.
Cool.
It's like an Amish barn raising.
Honest to God, that's what we said. I've got a little video if anybody wants to go look at the pictures. I don't know if we posted the video or not, but it's literally exactly like an Amish barn house raising, if you will. and again, the most important thing I want people to know is that Habitat for Humanity is not a giveaway program. The couple, our house is going to be lived in by a Burmese couple, and so they have to donate, Steve, 500 hours of sweat equity. That's 12 and a half 40-hour work weeks. Can you imagine that? Single homeowners have to donate 300 hours of work, and then they have to pay back a mortgage to Milwaukee Habitat that's equal to the assessed value of the home. So our home is at about 31st and Garfield, and that's going to assess out for about $96,000. Now the rate is a little bit lower than what we can offer people at Accunet. The rate for a Habitat mortgage is exactly 0%.
Wow!
And that's a good deal. But the cool thing about this, the money that Accunet donates and all the other entities, individuals or corporate sponsors, we're putting up the money to build the houses. But then the homeowners pay back the mortgage, and as they're repaying that principal every month, that's recycled. It goes back into the fund and gets put out in terms of more homes. So that's really cool. The average homeowner for Habitat earns between $25,000 and $44,000 a year. That's what I learned.
Mm-hmm.
And in order to qualify, Steve, they have to go through a 9-week financial literacy class, and they also get training on basic home repairs. Plus, they have to work on the site, so they know how to swing a hammer. And they end up typically from spending almost half of their income on housing in the form of rent to by the time they're in the Habitat house, they'll end up, I did the math on this and confirmed what I learned this week, they'll end up with a mortgage payment of about $500 to $600 a month, all in, including property taxes and insurance, and then the principal payment. They pay no interest, so that's the benefit. The other thing that I learned this week, I did not know that Milwaukee's first zoo was at Washington Park, and until they moved it in the 1960s to its current location. Have you ever worked on a Habitat house?
Yes, I have, and it's really a inspiring thing. I mean, and a lot of camaraderie and friendships get made on stuff like that.
And you're really outside your comfort zone. I mean, when you think about us mortgage guys going out there and then swinging a hammer, I got to tell you, on Monday when I showed up, and by the way, I was dog tired. I worked all day Monday, because I'm not used to working outside in the sun, right, and swinging a hammer and lifting lumber and all that stuff. I slept really well, and then I worked out there every other day in the morning with my team. So it was a great experience. If you want to support Habitat, just go to their website, MilwaukeeHabitat.org. They've got the restores out there. You can volunteer. They have a tremendous group of volunteers that work, every week during the summer. So it doesn't have to be just during the special Blitz week. What a fantastic organization we have. They've now built 1,000 homes in the Milwaukee area since they started in the mid-1980s. All right, when we come back from this first break, we're going to talk about the other end of the housing spectrum. We're going to give you the scoop on the home that President Obama and Michelle Obama just bought in Washington, D.C. when we come back.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ.
Getting you into the home of your dreams. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, it's U.S. Open week here in Wisconsin, and with it comes a lot of money flowing into the local economy. Just how big of a boom will the tournament be for the area's bottom line? John McKeer shares the eye-popping numbers at 3:20 tomorrow afternoon on Wisconsin's Afternoon News. You're listening to the Accunet Mortgage and Realty Hour here on 620 WTMJ. Brian Wickert is with us as we take a look at the Obama's new house they just purchased in Washington, D.C.
Yes, I picked up on this in the mansion section of the Wall Street Journal, but it was first reported by the Washington Post, so let's give credit where credit is due. Barack and Michelle Obama have snapped up the 1920s brick house they were renting in the posh Washington, D.C. neighborhood of Colorama. Are you ready? For just $8.1 million. Wow. The former president and his family plan to spend at least another 2.5 years in the nation's capital. Their spokesman said it made sense for them to buy, instead of continuing to rent. The Obamas have been living in the 8,200 square foot home since leaving the White House in January. You might even think of that as an upgrade, by the way, from the White House. They intend to stay in D.C. until their youngest daughter, Sasha, finishes high school. The house was renovated in 2011 and includes 9 bedrooms, 8.5 bathrooms, a finished basement, which has room for staff, an oversized terrace, and formal gardens, according to the former listing with the Washington Fine Properties. There's also 2-car garage, plus ample parking for a Secret Service detail in a gated courtyard that fits 8 to 10 cars. That sounds just about right. The sellers were the Lockharts. She was the Washington editor of Glamour, and they bought the place in 2014 for just $5.3 million. So I don't know if they did any renovations to the house, but that's a pretty nice increase in value, $2.8 million. Now, here was the irony, I thought. Colorama, which I had never heard of, but it's a popular spot for the D.C. elite. Mr. Obama's neighbors, ironically, include top advisor to President Donald J. Trump, Jared Kushner, and his wife, Mr. Trump's daughter, Ivanka, as well as Secretary of State Rex Tillerson.
So, holy cow. What a neighborhood.
By the way, Yeah, I did a little calculation. The most I could lend, the biggest loan we can do at Accunet Mortgage is $3 million. So let's say that the Obamas took $5 million from their book deals, put that down, and decided to get a mortgage with Accunet. I'm pretending we could lend in Washington, D.C. We can't. But a $3 million mortgage, and then I guess that maybe taxes are low, and they're only, let's say, $100,000 on that place, and then property or insurance would be about $2,000 a month. Monthly mortgage payment, including taxes and insurance, $24,500 a month. What it would cost to carry the debt and make the payments on that property. That's if you put $5 million down. And by the way, in order to qualify under the federal government's rules for qualified mortgages, remember we have these laws that say you have to be able to have documentable income.
Right.
If you can pay back your mortgage, he would have to bring down $700,000 of income, assuming he didn't have a car payment. And I don't think he does. I don't think you get to ever drive again once you're president of the United States. So there you go, the other end of the spectrum. When we come back after this next break, let's talk about the May home sale numbers in southeastern Wisconsin when we come back.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ.
Find a place to call home without the headache. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, Marquette head basketball coach Steve Wojciechowski is preparing for his 4th season with the team. So how will he gauge success? You can hear Greg Matzek's exclusive hour-long discussion with Coach Wojo coming up at 11:07 this morning during WTMJ Conversations. Brian Wickert is with us. We're taking a look at the May home sale numbers at this point here on the Accunet Mortgage and Realty Show.
So these numbers come to us from the Greater Milwaukee Association of Realtors Multiple Listing Service, of which I'm a member because I'm a broker with Accunet Realty Advisors. And I've got good news. Single-family home sales were up just slightly in May, somewhat to my surprise. There were 1,830 homes that sold using the services of a realtor in the 5-county metro area. That's Milwaukee, Waukesha, Washington, Ozaukee, and Racine counties. That's 17 more homes, Steve, than sold in May of 2016, a 1% increase. What are you going to wager on condo? Flip of the coin, you think condos were up or down?
Down.
Compared to a year ago. Down, you are correct. Yeah. 5 fewer condos were sold, according to Multiple Listing Service, in May, 412 units. But on a combined basis, if you add the two together, we're up an entire dozen of home and condo sales for May. That's good news. But here's the even better news. There were 472 condos listed for sale in May. That's 20 more than a year ago. And on a year-to-date basis, we're 21 listings greater than last year. Single-family listings in the 5-county metro area were also up. 2,602 homes were listed for sale in the MLS in May. That's up 2.4%, or 62 listings more than what were listed in May of 2016. So here's the takeaway there, folks. For all the discouraged home buyers out there who have maybe either thrown in the towel or are thinking about throwing in the towel, we had 2,600 new homes came on the market in May and only 1,830 sold. So that's additional inventory of about 800 single-family homes. All right, now let's talk about how fast homes are selling. Because remember how we're always amazed that not every home sells in a day, okay? So we can divide the market maybe up into thirds. About a third of the homes selling in May were at under $160,000. We're just talking single-family homes. And on average, if you looked at homes that sold between $150,000 and $169,900, they took 1.6 months from the day they went on the MLS to the day they got the accepted offer. You move up to the $170,000 to $249,900 price range, and they sold faster, 35 days. Then you go from $250,000 to $299,900. It took a little longer, again, about 43 days. And then when you get up into the $300,000 to $450,000 price range, it takes longer, folks, 2.2 up to 3 months to get an accepted offer. Now, I was talking to a buyer of ours, and we talked about him last week, I think, where he's getting a large gift from his folks in lieu of a bridge loan. And their house is on the market. It's in the city of Milwaukee. It was on the market for 5 days. And he was getting worried because he only had 5 showings and 1 offer. So people aren't necessarily realistic, right? It's like, hey, man, so I just, putting out the word here that it usually takes at least a month. If you're in that 170 to 250 price range, it's taking a month, or about 35 days.
Sure.
You plant it's not instant all the time. Now, this guy, he took the offer. We talked about it, and it was a full price offer, so why not? And, they're on their merry way. If you go up to 450, you get into this range, 450 to 750, now you're looking at 4 to 5 months on the market before you get an accepted offer. And you get into that 750 and higher range, it's taking on average 6.2 months to get from listing to accepted offer. All right, when we come back after the news, we're going to take a look at where rates are and tell you what the percentage chances are of a Fed rate hike this Wednesday when we come back.
Getting you through the home buying process. Welcome back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
David Wickert is off today. Brian Wickert in, as he always is, as we are into the second half hour of the Accunet Mortgage and Realty Show here on 620 WTMJ.
I'm negotiating by text with David right now whether I can have next Sunday off. Yeah. I think it's Father's Day, right? Isn't next Sunday Father's Day?
Well, yeah, and it'll be the final day at Erin Hills. I mean, you should have it off. And
I'm going. Actually, David's taking me on Saturday, and then I'm going with Becky on Sunday. So hopefully it's not going to be sweltering out there, because I learned on Wisconsin's Morning News this week that Erin Hills has, are you ready, 5 trees on the entire golf course.
Yes.
So I'm going to be bringing my sunscreen for sure. Okay. So mortgage rates are great right now, unexpectedly fantastic. On a $200,000 30-year fixed rate with 25% equity and all the other right stuff, at the end of the week, low overhead Accunet could offer a 3.99 rate, not only with no points, but with Accunet picking up the tab on all the closing costs. Accunet's closing costs, as hopefully people know by now, are typically $1,000 to $3,000 less than your average bank, or definitely the online guys. Our regular closing costs are only $1,180. That's because we don't charge anything like an underwriting fee or a doc prep or administration fee. If you go to Quicken Loans, by the way, those numbers add up to just a little over $1,000 for all the fees that go into their pocket. We have 0. So what I'm telling you is at 3.99, we pick up the tab on the $1,180. That makes the annual percentage rate just 4.01%. All right, but on Wednesday, the chances of a Fed rate hike, Steve, are now, are you ready? 99.6%.
Wow, okay.
So I don't know what the holdout, who's holding out, but it's a virtual certainty. Here's the good news. The interest rate that I just quoted you assumes that the rate hike is going to happen. That's already baked into the cake. All right, so when they go ahead and raise rates a quarter point on Wednesday, that should not affect long-term interest rates like 30-year fixed rates, 15-year fixed rate. It shouldn't affect it at all, because the traders already know that's going to happen. But here's what is also going to happen for sure, and then I'm going to tell you what could happen or spoil the party for long-term rates. What will happen as soon as the Fed announces the rate hike, which will occur at 1 p.m. on Wednesday, the prime rate will go up instantly. So anybody who has a home equity line of credit, those are all, I've never seen a home equity line of credit that's tied to an index other than the prime rate. So the prime rate is going to go from 4% on Wednesday to 4.25% on Thursday. And now that's up 0.75% from where it was. For a long time, it just stayed there flat. So everybody's got a balance on their home equity line of credit is going to see the rate go up another quarter point. Okay, so that means there's still an opportunity to put that together. Of course, maybe you're carrying a $50,000 line balance on your line of credit. Well, we've been doing a lot of this lately where we put that together with a person's existing first mortgage. Maybe we wrap it together on a 15-year fixed. By the way, I just ran the numbers, Steve, before the show. About half of Accunet's refinance business is on loan terms of 20 years or less, and about half is on loan terms between 21 and 30. So we are helping a lot of people pay off their loan faster. So the opportunity there for people with a balance on their home equity line of credit is put it together with your existing first mortgage into one fixed rate. I just told you how we could do it with no closing costs or no loan costs. You know, it's a perfect way, and then let's pay it off a little bit faster. Let's do it on a 21-year amortization, or maybe you got 25 years left. Let's pay it off over 23. You can really, really rack up thousands of dollars of interest savings without your payment going up, just by shortening that loan term for 2 years. The other opportunity out there for people is to get rid of their monthly PMI. If you bought a house 3 years ago and you're paying monthly PMI, well, at 6% or even 5% annual appreciation compounded over 2 or 3 years, you just might have 20% equity. And remember, Accunet also has loan programs with less than 20% equity that don't have monthly PMI. So a lot of opportunity left on the table. Now, the thing that could spoil the party in terms of long-term interest rates relative to Wednesday's Fed meeting is something I'm going to tell you after we come back from this next break, because I just looked at my clock and it's time for another break. So when we come back, I'm going to talk about what could the Fed say on Wednesday that would make long-term interest rates go up when we come back.
Right here on the Accunet Mortgage and Realty Show on WTMJ.
Helping you find a place to call home. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, according to new numbers, more and more millennials are actually moving out of Milwaukee. What can be done to change that? Gene Miller talks to an expert about that at 7:50 tomorrow morning during Wisconsin's Morning News. So with regard to what the Fed is most likely going to be doing this coming week, let's focus back in on that certainty.
Yeah. So for sure they're going to raise short-term interest rates a quarter point, but that's not going to affect 30-year fixed rates or 15-year fixed rates, because we already know what they're going to do. There's a 99% chance the market believes that they're going to hike rates. Okay, but here's what everybody's got to look out for. What are they going to say in their statement about winding down their $4.5 trillion portfolio of mortgages? Because remember, back in 2011 through, I think it was at least 2014, the Federal Reserve was buying mortgages like they were going out of style in order to drive 30-year fixed rates down, in order to stimulate the housing market, in order to stimulate the economy, right? So if you have all these dollars chasing mortgages, that suppresses the interest rate. So now they're sitting on this big pile, and what they've been doing for 2.5 years, is taking all the principal payments they get and reinvesting it in more mortgages. Okay? Well, now what they've said, they've been talking about this since the beginning of the year, we think we're going to start to not go back and buy additional mortgages. We're going to let our portfolio shrink. In other words, they're going to reduce demand for mortgage investments. Now, the question is are there other investors out there besides the Federal Reserve that'll pick up the slack? If there's not, this will make long-term rates go up. And so depending on how strongly they word that and the pace at which they're going to let their portfolio of mortgages shrink. For example, the worst thing would be if they said, hey, in addition to just taking our principal payments and not reinvesting them, we're just going to hand those over to pay down the federal debt instead of going out and buying more mortgages. If they were to say, we're actually going to go out and sell, $1 billion a month, or whatever the number might be, of mortgages on the open market, that would be the worst. I don't think they're going to do that. but it's the pace at which they start to liquidate that portfolio that could make mortgage rates go. So I'm thinking on Thursday, long-term mortgage rates might be up a little bit. That's my gut, and I hope I'm wrong because they're fantastically low right now. By the way, I think we have a text question that came in. Do you have that handy?
Yeah, let me throw this out here. The question for Brian is: I have $75,000 left to pay on my condo. Current interest rate is 3.25%. I put an extra $240 per month on my principal. Should I stay the course? Refinance? If I stay the course, how soon will I pay off my loan with the extra on the principal?
Ooh. Okay, so I can't answer that question of how fast will you pay it off because I don't know what their current principal and interest payment is. If you want to text that in, I can answer that. But it sounds like you'll be done pretty quickly if you're paying that much off. All right, so my answer is if that 3.25% rate is fixed, stay the course because you're going to be done fairly quickly, and also it's a modest loan amount of $75,000. Just think about it. If you were able to lower the rate a full percent, that's only $750 a year, and you cannot lower the rate to full percent. 3.25% is the rate that we're able to offer on a 15-year fixed of $200,000. So in this particular case, as long as that interest rate is fixed, which I'm going to bet that it is, you just stay the course and ride that one down. The question I would have is, what else could you do with that extra $200 that you're putting towards principal? You could invest that, depending on the age of the person, into retirement or something other than paying off the mortgage, since they do already have such a great rate. So it's kind of an opportunity cost question. When we come back, I'm going to talk about another question that I got this week, a conversation about someone who owns their house free and clear and wants to downsize. We'll give you the tips that I gave them when we come back.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ.
Home buying advice from the guys who know it best. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And we are getting the questions and text questions coming in on the Accunet Mortgage Talk and Text line at 414-799-1620. This one comes to us from Barbara in Milwaukee. Brian, what are your thoughts about using a home equity line of credit to pay off your mortgage?
My initial thought is it's risky, and that's because all the home equity lines of credit I've ever had or read the details on are adjustable rate mortgages tied to the prime rate. And the prime rate right now today is at 4%. On Wednesday, the market believes there's a 99% chance it's going to 4.25%. And then I just looked up the chances of the Fed funds rate, in other words, the prime rate going up another 1/4 to 0.5% by the end of the year, and that is over 50%. So you're looking at the prime rate, if you're able to borrow at the prime rate, because a lot of times you're at prime plus 1/4 or prime plus 1/2 for your home equity line of credit. Just the prime rate alone is going to be at 4.5 or maybe even 4.75 by the end of the year, according to the Fed funds futures market. So why would you want to have an adjustable rate mortgage that has no practical interest rate caps, right? Every time the Fed funds rate moves, the prime rate's going to move and the rate on your home equity line is going to move. Now, all that said, the only reason you might want to do that is because the payments would be lower. Home equity lines of credit do not generally require any principal payment. You're just making an interest payment is the minimum you have to pay. So if you're looking for payment relief, yep, a home equity line of credit could do that, but you're taking on interest rate risk. So, when I can lend you money, 15-year fixed at 3.25 or, 3.5, depending on all the circumstances, whether you're taking cash out or just refinancing the balance you have, why would you want to trade that in for a rate that starts with a 4 that can adjust any month? So that's my answer. Is that a good answer, Steve? You like it?
I think that's a great answer. So we're going to see if we can get Brian reconnected here and a little bit better bit rate going on here. You're listening to the Accunet Mortgage and Realty Show here on 620 WTMJ. We were just talking about interest rates, and if you're curious about that, Brian thinks that, maybe they might just tick up just a little bit this week due to the Fed's almost 7% certainty that interest rates will be ticking up just a little bit. But on overall mortgage rates, it should not have a big effect. Maybe just a slight tick up. But again, something that we're following along here on WTMJ. But good advice there. I don't think I'd put myself in the risk of where interest rates are going to eventually keep just going up, because we know that's probably what's going to be happening.
Yep, you bet. The other situation, though, that I did have this week where a borrower called in, they own their current home free and clear, and they want to buy their next home and downsize before they go and put their house on the market. So I had two suggestions for them, and they don't want to end up with a mortgage in the long term. Okay, so now the interest rate doesn't matter so much. It's just a matter of getting from one house to the next, because they know they're going to pay off that loan. So I had two suggestions for them. One, get a bridge loan on the existing house that they're going to be selling, and we can hook them up with a local lender who will lend 80% of the value of the old home. And in that case, it's interest only, and there are actually no payments for the first 6 months, so that's kind of convenient. And closing costs are very, very modest. And now you're a cash buyer. And then the other alternative would be to put a home equity line of credit on the new house that you're buying, because you're, again, only going to have that for a few months or however long it takes you to sell the existing house. So that's a good use of a home equity line of credit, in my opinion. I'm doing a loan up in Green Bay. You know how I always tell people, Steve, to not give your commitment letter to the seller until the day that it's due? You've heard me say that. And that's because if something happens, and I always say, if you lose your job, and of course nobody ever thinks they'll lose their job, or I say if you get disabled, you get in a car wreck, once you give that commitment letter, if I can no longer approve you for the loan because now you're on disability income and you're only making 60% of what you used to, and now I deny your loan, because I'm going to find out. I'm going to call your employer within 3 days of closing, and if they tell me, oh, he's on disability now, and I deny your loan, it's too late relative to that commitment letter. Well, I had this borrower relocating from Oregon back to Green Bay. He was back at his Oregon house in the attic, just retrieving a box, and the joist in the floor, which was above the garage, broke, and he fell 15 feet from the attic to the cement floor. And luckily did not get killed or break anything. But I was telling him about don't give it to him early, and he said, well, you're not going to believe this, but I almost ended up dead or disabled. So there's a real-life example, low probability of it happening, but why not just hold on to that commitment letter until the last minute before you give it up? All right, this coming week, in addition to the Fed meeting, we do get retail sales numbers. That's an important part of the economy, so that could be a interest rate market mover as well. But my takeaway from the first section of the show is that there were 800 more new listings that came on the market than homes that sold. So inventory is growing a little bit. Don't be disheartened, buyers. If you still want to buy a home, this summer is a good time to do it. And I would encourage you, if you don't have a rock-solid pre-approval from Accunet, that's really an important element in your arsenal of getting a winning offer accepted. Click on the blue button for a rock-solid guaranteed pre-approval. It'll really help you get in the winner's circle. Also, still time to refinance. All you got to do is click on the blue button at Accunet.com. I may not be here next week, Steve, but David will be.
There you go. We'll have the Accunet Mortgage and Realty Hour for you right here on 620 WTMJ. It's coming up at 11 o'clock. We'll check in with Colleen Boland, who joins us from the WTMJ 24-hour newsroom next.
The preceding was a paid program. Advice and opinions expressed during the Accunet Mortgage and Realty show are solely that of the hosts or guests of Accunet Mortgage and Accunet Realty Advisors, and not WTMJ Radio or Scripps Media Incorporated.